Hello students, today in this video section we will see the factors which have a great practical implication for capital structure. The first factor which determines the capital structure is management control. The management control over the firm is one of the major determinants of capital structure decision. The equity shareholders are considered as the real owners of the company, since they can participate in decision making through the elected body of representatives called Board of Directors. The policy decisions are taken in general meetings of the equity shareholders, and the day-to-day working will be supervised through Board of Directors. The preference shareholder and debenture holders cannot participate in decision making. The financial institutions and banks who provide term loans can participate in a management through the nominee directors by having a convenient in the loan agreement. The preference shareholder can exercise voting power in general meetings if the company fails to pay preference dividend for 2 consecutive years. When the promoters do not wish to dilute their control, the company will rely more on debt fund. Any fresh issue of the share will dilute the control of the existing shareholder. The another determinant of capital structure is risk. In capital structure decision, two elements of risk are found. First is business risk and second is financial risk. Business risks are influenced by demand, price, input cost, fixed cost, business cycle, competitions, and etc. The business risk of a firm is determined by the accumulated investment the firm makes over time. A firm with high business risk prefer to have low levels of debt, since the volatility of its earning is more. A firm with a low level of business risk can have higher debt component in capital structure, since the risk of variation in expected earnings is lower. Financial risk representing the risk from financial leverage. It refers to the additional variability per share and the increased probability of insolvency that arises when a firm uses fixed cost of source of fund, that is term loan, debenture and bonds. The higher proportion of debt increases the commitments of the company with regard to fixed charges and repayment of principal amount in time. Income is another determinant of capital structure. Increase of return on equity shareholder depends on the method of financing and its impact on EPS and ROE. If the levels of EBIT is low from EPS point of view, equity is preferable to debt. If the EBIT is high from EPS point of view, debt financing is preferable to equity. If the return on investment is less than the cost of debt, financial leverages depress return on equity. When the return on investment is more than the cost of debt, financial leverages enhances the return on equity. Tax structure is also the important for the capital structure. Under the provisions of the Income Tax Act, the dividend payable on equity share capital and the preference share capital are not deductible, causing the high cost of equity funds. Interest paid on debt is deductible from income and reduces a firm's tax liability. If tax saving on interest charges reduces the cost of debt fund. The debt has tax advantage over equity. By increasing the debt component in the capital structure, a firm can increase its earning available to equity shareholders. The flotation cost of debt and equity are deductible over a period of 10 years. Premium on redemption can be deductible during the maturity period. Cost of different components of a capital will influence the capital structure decision. A firm should possess earning power to generate revenues to meet its cost of capital and finance its future growth. Generally, the cost of equity is higher than the cost of debt, since the debt holders are assured of a fixed rate of return and repayment of principal amount after the maturity period. Firms that adjust their personal capital structure in order to keep the risk of their debt and equity reasonable should have a lower cost of capital. A firm with a high level of gearing, its ability to meet fixed interest payment out of the current earning decreases. This increases the probability of bankruptcy, and as a result, the cost of both debt and equity rises. The basic objective of a financial management is to enhance the wealth of the firm by increasing the market value of the share. The firm's wealth is increased if after-tax earnings are increased. A company increases debt at a low cost with a view to enhance the earnings of the equity shareholders. The cost of debt is lower due to the tax advantage. A fixed rate of return is payable on debt fund. Any excess earnings over a cost of debt will be added up to the equity shareholders. Capital structure decision should always aim at having a debt component in total component in order to increase the earnings available for equity shareholders. Investors' attitude also determine the capital structure decision. In a segmented market, different sets of investors measure risk differently or simply charging different rates on the capital that they invest. By choosing the instrument that taps the cheapest market, firms lower their cost of capital. However, the trade-off in terms of availability of fund always exists. And another determinant which determines the capital structure decision is flexibility. It is more important consideration with the increasing of debt is flexibility. As and when the funds required, the debt may be increased and it can be paid off and when desired. But in case of equity, once the fund increased through the issue of equity shares, it cannot ordinarily be reduced except with the permission of the court and compliance with a lot of legal provisions. Hence, debt capital has got the characteristics of greater flexibility than equity capital, which will influence the capital structure decision. A firm maintains its borrowing power to enable it increase debt to meet unforeseen contingencies. The time at which the capital structure decision is taken will be influenced by the boom or recession conditions of the economy. In times of boom, it would be easier for the firm to increase equity, but in times of recession, the equity investors will not show much of interest in investing. Then the firm is to rely on increasing debt. Profit is another determinant of capital structure. A company with a higher profitability will have low reliance on the outside debt, and it will meet its additional requirement through internal generation. Legal provisions in increasing capital will also play a significant role in planning capital structure. Raising of equity capital is more complicated than raising a debt. The government policies and capital market regulation is a major determinant in capital structure. For example, increase in lending rates may cause the companies to raise finances from a capital market. Rigid capital market policies may cause to raise finances from banks and financial institutions. Monetary and fiscal policies of the government will also affect the capital structure decision. Company size also determine the capital structure decision. The companies with a small capital base will rely more on owners' fund and internal earnings. But large companies have to depend on capital market and can tap finances by issue of different varieties of securities and instruments. The capital structure decisions are taken in view of the purpose of financing. The long-term projects are financed through the long-term sources and in the form of equity. The short-term projects are financed by the issue of debt instruments and by raising of term loans from banks and financial institutions. The projects for a productive purpose can be financed for both equity and debt, but the non-productive projects are financed by using the internal generated earnings. Thank you so much and wish you a happy learning.